What's going on, traders? Welcome back to another video. Now what I'm going to show you is why I had you set up these two charts the way I did earlier. Remember, we set up one with pre-market data, and then we set up another chart that doesn't calculate after-hours data, pre-market data. It only charts pre-market close to pre-market open, or vice versa, pre-market open to pre-market, or sorry, market open to market close, right? So one chart calculates pre-market after hours, the other chart only market open to market close, okay? So in the earlier video, I didn't explain why we're doing this. Now I want to show you visually why we're doing this. Now I can wholeheartedly tell you that I've come to find that the reason for using it is most reliable and most noticeable when we're trading small time frames like 1 minute or 5 minute charts, maybe like 15, but I don't really trade 15 minutes or 10-minute charts. So, then I only really notice it on 5 minute and 1 minute. So if you guys trade other time frames more frequently, then of course, you'll be able to figure that out for yourself. But again, since I primarily focus on 1 minute charts and like 5 minute charts sometimes throughout the day, I've noticed some really cool similarities. And I'll explain why we don't notice this as much when we get into larger time frames. Okay. So watch this, right? Watch what happens. Remember earlier I said that typically stocks don't like to break outside of 2 standard deviations, which would be this line down here on the bottom, okay? Same with this one here, okay? That would essentially be two standard deviations out, okay? Well, if we go and look over here on this time frame, they're also in the same spot. So coming into that zone, we would probably think this is a really strong support because not only does the standard deviation trend match up on the left screen, but it also matches up on the right screen. So sometimes I see that as like a double support, all right? And don't worry if this is confusing. We're going to do so many more videos, it'll be cleared up. This might make it a little bit more clear for you. So the reason that we run these two different chart setups is so we can see more than the average trader can. The average trader does not even trade the system we trade off of right here. Most people don't, to be completely honest, okay? And then secondly, most people, if not pretty much anyone, charts like this, at least that I've come to find. I'm not going to say I'm the holy grail. This is the holy grail of all holy grails, but I haven't seen anybody else teach stocks like this, okay? So whether I'm the first, I couldn't tell you. But the reason we run both screens like this is because of this. Ready? Look at this spot right here, right? Nothing there, but look right here. Boom. That is like literally the perfect example I can give you as to why we run this double-sided system like this. Because there are traders that solely trade stocks and watch the stock market from a market open to market close perspective. And there are also traders that live and die by trading stocks in the stock market, seeing the whole market close, market open, after hours, and pre-market hours. If you're not familiar with after hours and pre-market, it's the trading activity from after market close and then before market open. Okay, so when we run this kind of double-sided system, it's very possible that we are going to be plotted with two different channels. Well, same channel, but just a little bit different. And so the channel will kind of give you more to go off of, okay? And the way that I can explain this the best is we're going to use the chart, in this case on the right. It could be on the left in other videos, depending on how my screen's set up. But again, the chart with pre-market and after-hours data, you can say we will use this mostly for dictating whether or not we're going to take a strong entry or strong exit, okay? And in this case, the left screen, we're going to use this sometimes for entry and exit, but it will primarily be for the understanding and knowledge to make price targets, okay, and understand when and where a pullback will occur. So when you're in a trade and it's going well and all of a sudden you get this really nasty red candle, you're going to know why that's happening, and you're going to know where it's probably going to end. So you're not like, oh, should I get out? Should I get out? Should I get out? You already know that it was supposed to happen before it happened, and then you already know where it's going to pull back to before it even pulls back, okay? So the one on the right, strong entry, strong exit. The pricing and the graphing on the left is going to be price targets and pullback, right? This is like your detailed blueprint right here, okay? Like this is what we're going to use a lot throughout the day to kind of understand where our stocks are going to move to, okay? And the reason I say that is because imagine, so again, left screen, pullbacks, fine detailed pullbacks, entries, to know where the pullbacks are going to happen, okay? And then the one on the right is strong entry, strong exit. And the reason I say that is because this, right? Look at the screen on the right. When we broke over this green line, you would have had no clue where it was going, but I knew in that moment, the first target we would go to is that line. That trend line would be our first move, right? So if you were to buy this candle here, you should have only been targeting as high as that in that time because that was all the market was offering, okay? That's something else you're going to hear me touch on quite frequently is what the market's offering, okay? When you come to the stock market, it's a market, right? And there's an offer, right? There's something that the market can offer you each day. And when you start to understand what the markets can logically, not luckily, not exaggeration, not unicorn, okay, not miracle or magical, mystical or wizardry, right? Logically, something that makes sense. Okay, when you start to get in the habit of looking at things in a perspective of what can actually happen, what would make sense to happen, then you're not going to be aiming for these crazy moves or big moves. You're going to start looking at the market a little differently. So in this perspective, if you trade this system, you would have known that if you were to get long here on this top, or if the move was keeping to go up, then it was most likely going to go to here and it was going to sell off, okay? And you guys hear me say first attempt, first attempt, first attempt. You can see how we got to this level and then we ended up going a little bit above it. Okay, I didn't know that we go a little bit above it. I had no idea. But what I do know is that whenever the price runs into your target for the first time, it will most likely go the opposite, okay? I wouldn't know that it was going to go back and touch it again. But what I would know is that if we went back and touched it again, it would probably sell off there too, okay? Same thing, right? Like right here, right? Good spot to buy a bounce, sure. Who cares? It came all the way back down to that point. I didn't know it was going to do that. But again, look at first attempt into that level from a long time ago, bounce, okay? So we're going to do a couple more examples of this, right? I'm going to go look at the stock Netflix here. Let's see if there was any similarities, all right? So if we go back and start the beginning of the day, right, and we look at the left screen to the right screen, all right? The right screen would have you putting, right, if we looked at the right screen, we would have resistance starting at about here, all right? And on the left screen, we had resistance starting right there. So again, that can give you a better indication, right? Let's go down a little bit. Ready? Watch this. On the left screen, we had support starting here with the support as low as here, and you look where it lines up on the right screen, okay? So this is there to help you not get faked out and to also understand that if you started buying the bounce, if you were to start buying the bounce here, let me delete some of these things off. So let's say you wanted to buy a bounce. Here's a great example. Let's say you wanted to buy a bounce and you're like, okay, you know, the blue line's coming up like right here. So I'm gonna start getting long here and then it shakes down. Rather than you stop out, you should look at your right screen and go, oh, we actually have another support level coming in just below this blue one. So again, stocks normally don't break down that level first attempt. So even if it comes through here and it goes to here, right, we should let it bounce first, okay? Remember what I said earlier? The right screen is for strong entry, strong exit. Left screen is for pullback, fine detailed price target, okay? So, as I mentioned, right, the one on the right, strong entry, strong exit. So it doesn't really surprise me that we broke the blue line over here, went down a little further, then bounced on the blue line here because the right's for strong entry, strong exit, all right? Look at this pop here. Look at this random pop in the middle of the day. Guess where it goes to? Dink, right there, okay? So the one on the left is normally how we're going to be able to see where pullbacks and things are going to occur, like this, okay? Look at this jump up here, all right? Look at where it rejects off the green line here. And then look at where the pullback bounces here, almost off that line right there, okay? At the time, it probably was here. And these channels will move throughout the day, and you'll start to learn that and experience that. But let's look at a couple other things. Let's keep going through these just so you guys can get the idea, all right? So looking here, right? Looking here at this stock. Let's get the drawing tools on. Look at all these stops. Look at this top here. Look at that top there, all right off this trend line. Okay, you know what I mean? Look at this bounce here. Look at that bounce there. Look at the bounce here. Look at the bounce here, right? If you were looking at the right side of AMD and you said, where did this bounce happen? Why was that bouncing there, bouncing there, bouncing there, there, right? Look at where it's at. Trend line, trend line, trend line, trend line, trend line. So all these bounces on the left screen were lining up perfectly on this trend, right? Whereas over here, you were just bouncing off of no man's land. You're bouncing right in the middle of the channel. Now you could say, now let me ask you, if someone's ever taught this way before, which we do to a degree, that we would say we've bounced here before, so that's support. We bounced here, so this should hold over that, right? We bounced here, so we should, right? But you bounced, but you can see how all the bounces are a little higher than the previous one. So you tell me, do you think that the stocks are bouncing because we bounced off support once, so we should bounce off support again, and we should bounce off support again? Or do you think that what's really happening is we bounced here before, but we're really just coming back to test trend, bouncing off trend, bouncing off trend, bouncing off trend? So do you think it's actually support bouncing off of previous price level? Or do you think it's really support as we're testing the uptrending statistical trend? It's statistical trend that we're bouncing off of, but you will come to find in often many cases that the statistical trend does happen to line up. And when I say this, let me delete these drawings. You will come to find that the statistical trend does oftentimes line up very close to a previous support. So that's where the previous bounce was, right there, right? And support is really right here. So yeah, if price, and say you didn't know that, say you didn't know that the trend existed there, right? You would just see this as a move all the way back down to the low, and it's just bouncing because this was a bounce. So we have support here. You would say this is support down here, which isn't wrong. You're right. But if you look at support as a horizontal system, you will most likely always be buying late to early, because this trend line could be a bit above the previous bounce. The trend line could now be a bit below the previous bounce. So you know when you've tried to buy support before and then it kind of shakes down and then you stop out and it goes back up, or you're waiting for a bounce at a price level and then it bounces before it gets there. That's most likely because your stock is actually bouncing off trending support. And if your trend line is actually above this bounce level, right, like it is here, or in, you know, a different case, if it was actually below and say it was down here, then your price would either bounce like this or would move through that point and then it ended up bouncing down there. So you will come to find that your statistical trend does coincidentally, right, line up right next to previous supports and resistances, which can very easily make the traders think that the market kind of works on this horizontal support and resistance fashion. But what it actually does is it works on a trending fashion, and that trending resistance normally lines up, or the support normally lines up close to those resistances in the past, which makes you think that it's a horizontal game, but it's actually a trending game. And that's why you might get chopped out very easily sometimes, okay? So that is, for now, I believe one of the best ways that I can explain why we run the two chart system, because there's traders that watch stocks from market close to market open, and there's traders that watch stocks from pre-market, after hours, all sorts of hours, right? And so when you watch both of these charts like this side by side, you're essentially watching two different trading markets at once, where you're seeing what traders would be doing on the left side and you're seeing what traders would be doing on the right side. And when you mash those together, you're just giving yourself a stronger set of data points to go off of, okay? Because you're just looking at more calculated data in more trending fashion, right? So you can essentially, it's like double dipping the system in a sense, okay? And a lot of the traders in our room have found fantastic success Basically just being patient and trading the same system. Okay, so I hope you guys like this video. What we're going to go into next is we're going to start looking at the larger time frames, and then we're going to kind of map out how we would start that day. We were supposed to already do that, but this video I realized I had to kind of touch on the details of why we run both screens. And you will now notice, right, like you could see how there's a big difference in this level. Okay, like look at where the trend is here. It's right, you know, the trend's all the way down here on that screen, right? Trend starts like right here, right? But trend's all the way here on this one. So you can see from this line to that line, there's like $1 difference or something. This is 51.92 to, sorry, 51.65 or something. So like a 30 cent difference there. That's a pretty big difference in those trend lines, right? There's a lot of leeway there for uncertainty, okay? As we get to the larger time frames, you're going to notice that there is a far less difference, right? Because as you get to bigger time frames, right, there's actually less. You'll see what I'm saying. You'll see what I'm saying, right? Rather than me confuse you, right? So watch what happens when we do both of these on a year chart. Okay, let's look at where this trend's at, right? This middle trend is at 54.54, and this one here is at 54.59. They're only off by a couple pennies, right? So as you get into the smaller time frames, there will be a slightly bigger difference. Why? That's why we use those two different charting techniques during intraday trading religiously, because it's giving us that extra set of data that we would need as an intraday trader to understand all those what if and scenarios, and to map out where the lowest possible risk entry would be for us to take. Okay, when we get to the bigger time frame, running the two screens, I can't say is too much more beneficial. It might actually confuse some people more than others, right? But at the end of the day, you can see as we go to the larger time frame, these trend lines are going to match up pretty close. So you can see this is at 63.92 and this is at 63.94.80. So they're practically the same, right? So you're practically the same. But it's when you go into, say, a 1 day 1 minute, right? You go to a 1 day 1 minute, you're going to see a big difference, right? This top line's at 53.51. This is at 55.04, right? So again, that's why it's primarily we're going to run these two techniques on the smaller time frames, okay? So now what we're going to do is we're going to jump into the large time frame, show you how we work off that, and then we go into the small time frame so we know pretty much what our game plan is going to be for the days ahead. Okay, guys, everybody stay tuned. Next stuff coming up is going to be pretty good.